David Drozd is President and Senior Marketing Analyst for AgChieve Corporation. David is a graduate in agriculture from the University of Manitoba with more than 20 years of family farm grain experience in Fanny-Stell. His off-farm work as a commodity broker led him to found in 2002, one of Western Canada's premier grain marketing firms. AgChieve's niche market is charting and technical analysis, in which David has over 35 years of experience. Please join me in welcoming David Drozd.
Thank you. Okay. Good afternoon, everybody. Got a question for everyone. Who thinks we're going to see $12 canola by July? Oh, there's some bullish folks in the audience. Right on. Who thinks we might see 9 before we turn around and go back up? No hands. There's one. Okay. You know, and that's what makes a market. You know, every day somebody believes it's going up, some believes it's going to go down, and that's what makes us a trade, and that's what, you know, evolves into what the price is that day. I just want to mention here for beginning, I know a lot of you heard my story before, but just real quickly, if you don't mind, if I tell it one more time. I did farm at Fanny-Stell, Manitoba, up until '97, grew up on the farm, but also worked as a commodity broker for 5 years in the '90s. And what I learned was that a lot of the clients I had were really interested in the information I had. And there were days where I would just call them and say, hey, Cargill Elm Creek's paying $4 for oats. We sold our last 40,000 bushels here. I think you should do that the same. And it was a rally on the chart in May. You got them when they were busy on the tractor seat, and they said, great, I'll get that done. But at the end of the day, they didn't short the futures market, they didn't buy a put, and we all work on commission when we're a commodity broker, and I didn't make any money. But I had given some really good information and advice to our clients. So I thought, you know, would farmers pay for this type of information? And I, you know, talked to people in the trade that I knew, and they all said the same thing. Oh, David, farmers won't pay for information. Others have tried and failed. Don't even think about it. And, you know, here we are, actually 17 years later to the day when I started AgChieve, and we now have hundreds of clients across all 3 prairie provinces. So I want to thank all of you who have helped me prove the naysayers wrong. And, you know, what a lot of you know is my niche, or our niche at AgChieve, is charting and technical analysis. And that's what I'm going to share with you here today, is looking at the charts. We believe that charts forecast the futures because history doesn't change. You know, past formations repeat because human nature never changes. And, you know, it's kind of interesting that I'm standing here today because the first time I was invited to speak here was exactly 10 years ago on January the 19th, so almost to the day. And if any of you remember what the markets were doing on that date, I sure do, because I was the one standing here and everybody was wanting answers to what happened with this subprime mortgage fiasco. The stock market dropped, crude oil dropped, grains dropped. Will we ever see things turn around? So just from a little nostalgic point of view, I thought I'd just start out by sharing with you some of the slides I had that day relative to where we are today. So here's the first slide. This is one of the ones that I shared 10 years ago. It's the Dow Jones Industrial Average. And you can see it moved from 14,000 down to 7,000. And that's the date that I was standing down here. And everyone's wondering, will we ever see things turn around? Well, here's a current slide. Almost to the day it had stopped going down, and it rallied to 27,000 in 10 years. But all the doom and gloom that was in this room 10 years ago. You know, now there's nervousness about the stock market, what's it going to do? It's had a little bit of a pullback here, but by means nothing like we saw 10 years ago. So, you know, look at how things can change. Here is the S&P 500. There again, you know, it went from 1,600 down to 800. And, you know, looking, you know, ahead here now, it's had a significant rally to that $2,900 level from there. So, you know, this is what one of the things the market does is when you're down at the bottom, the news is incredibly bearish. Expectations are for it to get worse. And, we as farmers maybe hear that about canola, say, down, and we may sell some because it's going to go lower, no sooner than it turns right back around. Well, it was the same thing about the stock market back then. No sooner had it's gone down like that. And I remember there was one person that was buying a lot of stocks at that time, despite the bearish news. Maybe some of you have heard of him, Warren Buffett. I think he did all right. See, there was someone that wasn't following the crowd. This next slide is the Canadian dollar. Just to show you here that it was down around 80 cents 10 years ago. Well, here not so much has changed. We're at about 75 cents today relative to the US. So that one, moved up and then pulled back down, but we're roughly where we were. Crude oil was in the headlines. In June of 2008, crude oil was going to the moon. This is a Maclean's magazine article that I shared with you 10 years ago. What would life be at $200 a barrel? Now, this was in June. And when you start to see news in a magazine like this, you're usually near the top. 1 month later, crude peaked at 147. 1 month after that magazine came out. So this is kind of like when you go to your dentist, and your dentist is telling you, you know what, soybeans are 15 bucks. I phoned my broker and I bought some. You go home and sell the rest. So the crude oil, though, is right back down to where it was 10 years ago. We're right back into that $42 to $50 range. So not much has changed on that front in 10 years. And hence, the Canadian dollar hasn't changed much because our Canadian dollar is influenced by crude oil to a large extent. Spring wheat. Spring wheat back then was about $6.50 on the Minneapolis exchange. And oh my gosh, was there doom and gloom because we had just come off at 25 bucks a bushel. Remember those days? How fast that changed. Back down to $6.50. And here today, Minneapolis wheat is $5.80. 70 cents less than it was 10 years ago. You thought all of this was going to be optimistic, right? Here's canola. 10 years ago today, it was at $4.45. Pulled back into an area of support. And here 10 years later, it's 40 bucks a ton higher at $4.85. So I'm going to keep going on canola here now. Anyway, I just thought that was interesting to look back a decade. The canola market here has been drifting lower. This is a downtrend with respect to looking at a chart. And, until it starts making a higher high, it's deemed technically that it's in a downtrend. So everybody would like to know, when is the trend going to end, when are we going to turn back up, etc. So I'm going to share with you that in a moment. But what I want to point out is that us chartists, we like looking for indicators that a market's about to turn down. Back here in the end of May, on a candlestick chart, a harami developed. And that's an indication that the market's about to turn back down. Prompted us to make a recommendation to our clients to sell old and new crop canola. We also sold old and new crop corn then, soybeans, wheat. It was just one of those rallies in May that we need to take advantage of this for cleaning out the old crop bin and getting going on new crop. And now on a harami, for those of you that want to look for something like this, it looks like this on the slide on a candlestick chart. And I'll just zoom in on it here, because I like to educate as well as just, give an outlook, that it's all about the body in a candlestick chart. And the candle on the left has a white body. That's the difference between the opening and closing price. It's a white body because it closed higher than it opened. It was followed by a black candle. And it's black because it closed lower than it opened. And that little black body within the large white one is a reversal pattern called a harami. So we're always looking for indications like that, especially if they're up near the high of an extended move. Because at the top of the market, you're always going to see more bullish expectations. And that leaves our guard down that things will be better, I don't need to sell today, or I'm going to think about it. And no one really raises a red flag. But in charting, you do get that red flag. And it's not always 100% accurate, but it works pretty darn good if you can pick up on this. And looking at, just a minute, I was going to say something else about the Harami at the high there. Oh, that's gone. But anyway, we'll go here now to the next slide. This is still canola, the March futures. And so if you're looking for a bounce in this market, it's going to have a couple of hurdles here, not too much higher from where we are. A 2-day reversal did develop at the bottom, indicating it's going to try to turn up. Is it a major low and we're going to move up, or is it just another little temporary low, we bounce up and keep going down, remains to be seen. Resistance is up at 490 and then again at 496. And 496 is going to be tougher to get through because there's 2 intersecting lines of resistance there. So for me to say that the trend is starting to turn up, I'd like to see us start to trade above 496. So, but right now, a bounce could very well run into trouble at 490 initially and then 496. So let's look at the bigger picture. This is a monthly nearby futures contract, and it goes all the way back to 96. I'm more concerned about talking about the 2 parallel lines that I've drawn there, because it gives you a point of resistance and a point of support over the last few years. And really, if if you're doing your budgets and you're saying, well, where does canola trade? I got to figure things out. It's between, 535 and 475. When we also went to make that recommendation at the end of May, the futures were at 530, very close to this high at 535, this line of resistance. And there's one thing about charting is that the further that you move, like we had a big move up here to go from 475 to 535. Oh well, used to be a laser mark there. It runs out of steam. You can see there it started out the lower line, ran all the way up to 535 before it came back. It's like you running up the side of a mountain. You're going to run out of steam somewhere along the way before you get over the plateau. So it hits the plateau and it's got to rest. It's like, I made it. And that we call technically overbought when we're looking at charts. If you're looking at MACD or RSI indicators or slow stochastics like I do, they're very near the top of the page indicating they're overbought, and technically they're about vulnerable to turning down. Do some of you in here look at indicators like that? Okay. So that's just another indicator that we like to watch to advise our clients on when it's time to make a sale. Here again is the canola, but instead of a monthly chart, this is the weekly nearby futures contract. And right now, when it slipped down to the 471 area, it fell to a 2.5-year low. And when I look at this, just going back up again, if we break support at 475 or the 471, it is going to open the door to additional weakness from a technical point of view. In order for the market to get going above 535, it needs to move up above that. So looking here at the weekly chart, you can see that we saw a couple little ticks up above 535 here going back to 2015, but they were generally in the spot month. And you weren't really able to capture that on the futures because the grain companies had moved to the next month already. So really, 535 is about that high magic number. If you see it, where the market then starts to have some trouble. If this market does start to slip down below 471 here, it could open up the door to those other lows in that 445 area. Okay? Well, we've been there in 2016. Seems like a long time ago, but it's not like we haven't been there before. So from a technical point of view, it's very important that 470 holds here. And if we start pushing above the 490 and the 496, I have more confidence in saying, okay, that 470 low we just saw is going to hold and we're okay. We're going to start to turn back up. But right now, there's still pressure because the trend's still down. We often hear about, use charting for futures, but we can also use it in cash charts. And at AgChieve, we create our own cash charts. because they give you a different perspective than the futures, because the basis comes into play now. Canadian dollar comes into play to give you that cash price that you get paid with. And when the canola market was rallying up into May, we also had an uptrending channel here on this one-year cash chart. And you can see that when it broke the lower boundary of the uptrending channel, it also continued to move lower, just like it did on the futures. So I believe it's also important to watch the cash price too. Here's a 5-year chart, prices, the cash prices going back 5 years. And again, your resistance here where I drew it is up at 12, and supports have got in and around the $10 area. And therefore, it's important that we hold here around $10. And these are always watching the nearby elevator points. So it's a standard. So generally, I'm not saying it's the highest price, the lower price. It's our standard. We look at the same spot all the time to get these charts. So you can get resistance and support on a cash chart just as easily as you can on a futures chart. And for those of you that have been asking, can we get to $12? Yeah, we can get to 12. I just don't see anything today that says we'll be there by July. But if it got to 12, that's the place to make a sale, because if it ran from here all the way to there, it'd be running out of steam, like going up that mountain. And then, of course, as farmers want to open the bin at 12, you have some neighbors that do the same thing. And this is now where sellers are willing to sell more aggressively, and the buyers are reluctant to bid it up, and that's what's called resistance. The 2-year canola chart, I look at this one as well, and you can see the different time frames give you different indicators. The upper dashed lines at $10.75, and the lower lines at $10. So from a perspective here, I've been saying, if we need to get above $4.96, it would start to look a little better for canola turning up on the March futures. On the cash chart, if you're nearby, spot months started getting above $10.75, that would be an indicator now we're opening the door to higher prices. And if you've been watching the prices over the last few months, it's hard to get to $10.75 for delivery next month. You might get to $10.50, $10.60. The deferred months, you could see 11, but not much better. You're picking up the carry in the market that's willing to pay you storage a little bit to deliver it out in May, June, for example. So from if someone's asking for advice, if you're looking to sell canola sooner than later, what we've been suggesting is on the high end, going out a month or so, target 1060, 1050, 1060. And if you're looking for 11, you're going to have to put your orders out further into that May, June, July period to see if you can get them picked up. And some of the crushers, they're at 11 for deferred delivery today. Taking a look at the soybean monthly nearby chart, I just wanted to show where soybeans have turned up from here recently. And I don't know if you realize it, but they got all the way back down to that 2008 low. We always said, back then we're in a new higher trading range, a new era now, and and that's our floor. Well, soybeans decided to go back and test that floor recently. And so I'm just going to make a couple points here as I go through the next few slides. And I guess the point I'm getting at is, I hear sometimes that, well, how come canola is so low? And some may say, what's holding it up? No offense. There's two ways to look at that. So from this perspective, you can see that soybeans are down at the 2008 low. Soybean oil is also at the 2008 low, and it has a huge influence on canola prices. Canola, though, is only at a 2.5-year low. If it was at the 2008 low, it'd be $3.55 a ton. Now, are there any reporters here? Don't go say David at AgChieve says it's going down there. That's not what I'm saying. This is just an illustrative purpose to show you from another perspective, as I've just shown you, canola is actually holding up pretty well relative to those others that I just shared with you. So then you go, well, what's holding up? Could it be the Canadian dollar? Maybe the Canadian dollar is a whole lot weaker now than it was back in 2008. Nope, it's right about the same. It's right about the same. So therefore, that's neutral. Doesn't really have an effect on your canola price relative to 2008. So therefore, if you think that canola can't go below 470 to 445, what I just shared with you suggests it is possible. I'd like to believe that that would be it. We wouldn't stay there very long and we start to turn back up again. And this is why it's so critical that that low at 470 on the March holds, okay? Sooner we get back up above 500, start leaving 470 behind us, the happier we'll all be. The trend's starting to turn back up. So I just wanted to give you some parameters of support and resistance and where we might go if we get through either. Taking a look at the Canadian dollar, it's trending lower here now. It did turn up here a couple weeks ago, and it actually had a little bit of a gap up above that downtrending channel that I've drawn. Watching closely to see if it's a breakaway gap, meaning that Canadian dollar is actually starting to turn up. It pulled back pretty good today, but it didn't fill the gap when I last checked. If it does fill the gap, that doesn't mean we still can't go higher, but it wouldn't be a potential breakaway gap anymore. But it looks kind of encouraging that we're up above the upper boundary of the channel for the Canadian dollar to start to move up. For any of you that are looking to convert Canadian to US, I know you're waiting for the Canadian to move higher. That oops that we saw here at the high is another sell signal. It's an old Larry Williams technique where the market actually gaps higher at the beginning of the day, or this is the beginning of the week, and then in the same trading session comes back to fill the gap. As soon as it fills the gap, that's a sell signal. When I was a commodity broker, we would get clients to short the market at that point, saying, and all you do is put your buy stop above it, it either works or it doesn't. It works a lot of times. So that started to move down here, and it was just an indicator that the Canadian dollar is about to move back down. So again, it's just one more of those reversal patterns that we like to look for at AgChieve. Crude oil. This is the weekly nearby futures contract. There was a 2-week reversal right at the high, indicating the market was about to turn down. We had another one right at the bottom, indicating it was going to turn back up. And it came in at where those old lows were. Often old lows are support, and that's where a market can be expected to turn up. So far, crude has bounced off of that. It's going to have trouble getting through on the first attempt in that 55 area, 54 area where I've drawn the horizontal line. In order to turn the trend back up, we need to see it start to move up above that level. So it came close to that level and it backed off a bit today. And on a 2-week reversal, I've blown it up here if any of you want to watch for these. On the first day, the market closes higher than it opened. The little tick on the left is your opening price. The little tick on the right is your closing price. And the high and the low are indicated by the rest of the range. On the second day, the market starts out unchanged to slightly higher. And it needs to close below the midway between the opening and the close of the previous day. And you can see here that it closed right down below it. So it was a real classic 2-day reversal, or 2-week reversal in this case. So that was a strong indicator up at that high. And again, you sometimes see these indicators in the middle of ranges and all that. I don't put as much weight on them all the time, but the end of a run, a big move, that's when I've tried to take note of them, and they have a more likelihood of panning out and moving in the opposite direction as it's indicating. Taking a look here at the OAT monthly nearby futures contract, this market here now, has resistance up at 310, support at 220 in the big picture. For oats to move higher, and they've been doing pretty good, they need to get a decisive close above 310 on the March futures, the nearby futures contract right now. Until then, that is the high, that's resistance. Taking a look at the March futures contract, we had a 2-day reversal up at that high, and the market then turned down, held support at the old lows, turned up and ran into resistance here again. So again, it's stalling a bit here. We need to see it close above that high there at the 302 area or so to start to extend more gains. Here's the 5-year oat chart, cash prices that we track. And here again, you can see that they're up here at 5.5-year highs actually. So oats are doing quite well. And one of the things I've learned over the years, it's what you hold and what you let go. And if you're sitting on canola or soybeans per se, waiting for that market to turn around because you'd like to see if you can get a better price, the cereal grains are doing pretty good right now. They're at multi-year highs. And this here is just showing you where the oats is. So what we would often do is find out what someone's sitting on, and we'd rather sell the oats at these levels while we're waiting for, say, canola to come back. We just don't want anyone caught having to sell at the lows. But by selling at or near the highs, it helps you to sit tight before those inevitable lows come around again. And here's winter wheat, 5-year chart. It's also at a crop year high here. So again, there's opportunity to make a sale right now as well at these highs. Taking a look at corn, cash prices are doing quite well. They're also at a crop year high, getting up to those highs that we saw a few years ago. And again, those old 2 highs are resistance. So this is a pretty good place to price some corn based on looking at charts. Okay? Part of the reason for the strength in the cash prices has been weakness in the Canadian dollar. But if the Canadian dollar is starting to turn back up, then we might start to see these prices start to pull back a bit in the feed grain market. Feed wheat cash prices are also up at the high right now. Getting $6 in a lot of places or close to it. The years gone by, we didn't get that for spring wheat. So to me, where these feed grains are, there's opportunities today. So you're saying, but you're not forecasting higher prices, David. No, but we got the highs now. There's an opportunity here. I spoke in St. Jean a couple weeks ago at their Ag Day, and one of the gentlemen came up to me afterwards. He says, David, he says, you're usually more uplifting. You get the markets going. I says, Arnold, I says, I did all the work already. We're there now. So it's not always about where's the next high. Sometimes you're there. Reward yourself for sitting tight and you have an opportunity to make a sale now. And here's flax prices. We're bumping up above that $13 a bushel area. We need to get through 13 before we can see higher prices. Again, I don't rule it out, but that's the magic number we need to see the cash start to move up above. And as you can see, the chart reflects that, where the resistance is, and that's where it has stalled and it's pulled back a little bit now. Here's pea prices, yellow pea prices. We're up into that 7.25 area. Could we see 7.50? Based on this chart, yeah, we could see it get up into that area. Is possible, but I would say don't deny making a sale at 7.25 if you see that. Reward yourself for having sat tight for a whole dollar a bushel so far and selling it at a crop year high, $1 higher than it was. Here's the soybean March futures contract, and it's moving up here within this uptrending channel, but resistance is at 940 and support's at 880. And right now, I look at reasons why it would move up above 940, and I don't find many, if any. But however, if we slip below the lower boundary of this uptrending channel, it is going to open up the door to additional weakness in February, March. And if you remember years ago in the 80s when we had a large supply of grain and South America was coming on with their soybean crop, we just almost marked the calendar and you just didn't sell grain in February because it was always a low point with their upcoming harvest plus large stocks in the U.S. And that's exactly what we're looking at right now. The U.S. has got a record carryout of soybeans being forecast. Some say it could, touch 1 billion bushels. The last USDA estimate was 955 million bushels. That's huge. Plus, you're coming into availability from South America in another month. And there's been a lot of talk about, when there's a resolution with Trump and the soybean tariff is lifted, beans are going to take off and canola is going to take off with it. We started talking about this back in September, and the thoughts were that the longer it takes for a resolution to occur, the less impact it will have for the soybean prices going higher. And the reason is, If a resolution were to happen in the next 4 weeks, the buyers are just going to look at it and say, okay, great. We've got all these beans available in South America. We've got all these beans piling up in the U.S. Where do we buy from first? They don't need to bid this market a whole lot higher. If you take, like in North Dakota, for example, their soybeans typically go to the Pacific Northwest. They're not moving. The alternative is down to the Gulf, and with the basis just indicates they're in the bin. They're not moving. Grain companies, their large stockpiles of soybeans are not moving. Farmers have the same. It's not a switch that goes like this, in my opinion, when the resolution is to be had. It's going to be a big ball that's slow to get going. You got to get beans moving out of the Pacific Northwest, for example. Well, you got to line up freight and everything else. It's just, that doesn't happen overnight. So unfortunately, if the resolution would have happened sooner, we could have seen a more positive impact of soybean prices. But now that we're getting into South American harvest coming up, therefore it may be difficult to get above 940 here in the next few months. But if we get under 880 on the nearby futures, it could open up the door to about a 50-cent downside on the futures. And the cash prices are already depressed. You know, they're down around 9.25. You know, back in October, you know, soybeans here were about 11.30 a bushel. I think the following few days they maybe touched 11.50 before they started to move down. At the same time, if you had looked to price beans for February, March delivery, they were $2 a bushel less. The market wasn't paying you to store soybeans till then. Usually when a market's not willing to pay you soybeans till then, you don't store better soybeans till then. And so far, the 11.30 has been a good point to make a sale, as we're nowhere close to seeing these markets turn around in a cash market. I'm not sure why they're so weak relative to the futures. It could just be that, you know, traders either don't have the sales on the books because possibly they're lining up in South America instead of the U.S., or they just don't want to take on that risk. So it's been like that for a few months now, where we've seen depressed prices here for February, March delivery. Here's the soybean cash price, been trading between 11 and 9.50, really crowding that lower boundary here now as we get down to 9.25. So that's starting to slip a bit. Where do you sell soybeans? Get back to 10.50 or 11, I'd make a sale on soybeans. I don't like chasing weakness no more than you do. It's one of the ones, if I don't want to let them go at 9.25 right now, so you lock the bin and see if we can get better prices as we move forward. Spring wheat, you know, this market here has been trending lower as well. When prices rallied up into resistance in May, and then again here in August, they ran into resistance, made a couple of reversal patterns indicating it was going to go down. And again, that's key. You ran so far up, you hit resistance, and there's a sell signal, and the market's technically overbought. That's what we look for at AgChieve to recommend a sale. Market has moved lower since and made a new contract low. But meanwhile, your cash prices for spring wheat were at a high here in December, right back to your summer high. How's that? Your futures are at lows, and we make a recommendation to price spring wheat back at the high we had in the summer. The reason is the basis improves so much relative to the futures. And here's when I'm getting close to the end of my slides here. This is, the red line is the basis, and the blue line is the futures price here going back 12 months. So I made reference that we recommended a sale on May 25th. The futures were at a high, but your basis was also improved a lot, and it was up near, you know, a new high. So combined with that, the fixed price was as good as it got, basically. Then your futures crashed, your basis went sideways around 80 cents, and then the futures popped, and then they came back down again to where we are now, but your basis continued to improve here into December 13th, where we made another recommendation. And if you take a look at it, your basis improved about 60 cents. You know, it went from about 60 cents over to $1.20 over here into December, while your futures lost 60 cents a bushel. So therefore, you're able to still get the price that we saw back in the summer. So therefore, it's not all about just watching the futures price. There's a lot more to it. And believe me, it seemed weird making a recommendation to sell spring wheat when the futures were making a new low. But the cash price was near the high, and the basis improved because the Canadian dollar fell back so much. And that Canadian dollar really influences your spring wheat prices. So it's timing in order to click on the futures and the basis at the same time to give you a good fixed price. Here's my last chart. It's the Kansas City Winter Wheat Weekly Nearby Futures chart. So it goes back here to 2013. You see that saucer-looking pattern? It's called a rounded bottom. This is how the wheat market likes the bottom, putting in formations like this over time. It needs to develop the platform yet, which I've drawn 2 lines there. I'm not sure they're drawn accurately, if that's the platform, if it'll be readjusted. But basically, it'll look something like that, where you just come down below the saucer a bit, and then it'll move up above the top of the platform, and that now sparks the beginning of a rally in wheat. So this is now what we're watching to help identify, are we truly turning the corner in wheat? So far, no. It takes time. I mean, that rounded bottom has taken 6 years so far. Back in the early 2000s, it took about 7 years for the market to finally stop slipping and go. It wears everyone out first. So I think that, over the next year possibly, we could start to see this market start to improve and start to move higher. I'm not saying it's going to happen tomorrow, but I'm encouraged because this is on a longer term chart. The weekly chart, not just a daily chart, or a minute chart would even have less validity because it's such a short time. But we as farmers like to look at the bigger picture, so we look at the long-term charts such as the monthly and the weekly, and I'm encouraged by this. Is it a guarantee? No. It could break down below the lower part of the platform we're seeing and negate it totally, but this is something that's in the works right now that we're keeping an eye on. Right now, the other thing to watch for Kansas wheat turning up is when it goes back to a premium over Chicago wheat. Right now, Kansas City wheat is less in price than Chicago, and that's not normal. Normally, it'd be about 50 cents premium to Chicago, Kansas over Chicago. Whenever we see Kansas cheaper than Chicago right now, your traders out there are looking for an opportunity to buy Kansas and sell Chicago, and that in turn starts to turn it around. So, to me, marketing is all about managing your risk. What I find is successful farmers, they have a marketing plan. They know their break-even price per bushel, so they know when they have a good price. They know how profitable it is when they price it. They know their cash flow requirements. They take advantage of profitable pricing opportunities, and they stick to crop rotations that work for their farm. We're getting a lot of questions now about what to plant next year. And with respect to the charts, what I like using them for is identify the ranges, use the charts for objectives and selling target prices. Those areas of resistance are good places to put grain pricing orders. Don't put them above it. If it goes above resistance, it's going to go higher. You don't want it filled there anyway. In fact, if you want 11 for canola, maybe put it in a little less than 11 to get in before everyone else does. Not every target 11 may necessarily be filled if they don't need that big an order filled. Watch for those reversals at the high to give you those sell signals. Use the fundamentals as well and other technical indicators to help with price direction. And again, don't get me wrong, even though our niche is charting, technical analysis, and that's what we like to work on, if you're using fundamentals and with your marketing plan and you're doing a great job of selling, don't change a thing. But for us at AgChieve, our niche is watching the charts. You do need to watch the market action each day. And again, set reasonable targets. Don't put them too high. And then sell into resistance, as I showed you. Protect your bottom line. And before the market turns down. And at the end of the day, you produce the crop. Shop around for the best prices at the right times. And once you make a decision and move forward, don't beat yourself up if the market goes higher. I know we're all guilty of that. Oh, I sold canola at 10 and now it's 10.20. If the plan was to sell at 10 and it took 10 months to get there, and that was your plan and it started and things moved up a bit, I'd say congratulations. You waited 10 months, you got your 10, that was your plan, and yes, it's higher. If you would have waited you would have got 20 cents more. But I'll ask you this. Would you rather sell the rest of your crop for less than 10 to make you happy? Or would you rather keep selling it higher? I'd rather keep selling the rest higher. So if anyone's interested in trying out our service here for 30 days, we've got a show special here all week long. For $5, you're able to receive our information, talk to us for 30 days. In fact, appreciation of everyone here today. We'll waive the $5 here today if you would like to sign up for the 30-day trial. Our booth is just outside the door here. Just stop by and we can help you out with that. And because it's a show, we're also having a draw. You could enter for a draw to have a grand prize of 1 year of service with AgChieve, and we've got 2 additional prizes of 3 months of service. So I want to thank you all for coming out to hear what I had to say today. It's always a pleasure to be out here at Brandon, and I hope you enjoy the show.